let's start with the theory so you guys can see what the important bits and pieces are that you need to obviously study and remember. When looking at this section, you'll see they talk about investments, they talk about interest, and they talk about bank charges. Remember, we've got two separate accounts. So we've got the business and we've got the client. Okay, the business has its own bank account, and so does the client, trust bank accounts. Do you agree, if the client gives us a lot of money, let's say they give us 100,000 to do legal work for them, 100,000 can earn quite a substantial amount of interest over a few months. So, are we going to just leave the money lying there and gathering dust? No. We're going to be investing that, potentially, in an interest-bearing account to generate money for both the business and the client, okay, because there's a relationship of trust there. So what's good for the client is good for your business as well, okay, because you'll see in some instances the interest can help you cover certain costs, okay, and we'll see what those costs are. The first bit is just looking at learning outcomes, key concepts, and then the introduction. The introduction is just focusing on, again, client transactions versus business transactions. It's important to identify who's who. That's the most important thing to do with any question. Let's just talk about the trust monies have to be kept aside. You already know that from last week. Right, here are the two investments. This is new. This is stuff that we haven't looked at yet. Sorry, I forgot to put this on silent. In terms of the trust bank accounts, we need to look at two different types of investment accounts. They classify them according to these sections in the Attorneys Act, as well as the Legal Practices Act. Okay, you guys probably have those acts. Yes or no? I don't. If you do, great. It would be nice to actually see, I don't know if you can, I haven't searched for these online to see if I can get a digital copy of it. It's probably a book or in a book that you have somewhere. Can you? Okay, so I'll go search for it. Yeah, I know with SICA, with that you can find Companies Act and all that, so you could probably find this as well somewhere. Okay, but I'm not going to refer to the legislation. You guys can look at that. What I am going to refer to, though, is this, the rules. Okay, so when and how do we treat those investments? So the first one is small a, the second one is big A. Okay, they're both two. So section 2, remember, if you look at the income tax, I'm familiar with the Income Tax Act where you've got the subsections. So they talk about paragraphs. So that would be like section 78, subparagraph 2, and then like A, okay, that particular section, okay. Right, so when you look at that, they say, there is no limit to the number of trust investment accounts an attorney's practice may open. The 4 trust investment accounts sections 78.2a and 78.2 capital A of the Attorneys Act and sections 86.3 and 86.4 of the Legal Practices Act are trust creditors accounts and are not included in the general ledger of the trust creditors ledger. Right, so that's important. Whose are they? Business or the clients? Clients. Okay, and that I would have thought about as default. Okay, money that's the client is money that belongs to the client, obviously. Okay, if you take money from them and you invest it on their behalf, it's still their money. It doesn't matter where you put it. If you put it in a current account or if you put it in an investment account, it's still their money. Okay, so that to me makes logical sense, and I wouldn't have to study that. The client's money is the client's money. It's the instances where it's not and where you have to pay it over to someone or keep it for something that becomes something that you need to look out for. Okay, so then they've got details here relating to the two sections. Section 78 small a of the Attorneys Act and 86.3 of the Legal Practices Act. Right, in terms of these sections, an attorney may transfer trust money which is not immediately needed to a trust savings account. Okay, this is looking at the requirements. Right, so if you're going to be doing legal work for the client, and if you know you're going to need money to register the bond, you cannot invest that money. That wouldn't be allowed. Right, you can only invest, inverted commas, surplus money. So if they've given you excess, and you know it's excess, because you'll have an idea of how much it costs to register a bond, or how much it costs to register whatever, or to do the work, okay? Only the surplus should be invested. Right, the bottom bit here is important, because they talk about the interest that is earned on that account. So now you've followed all the rules, you know that this is the client's money. You know that the client's money is going to be invested in an investment account. Trust money may not be deposited directly into a trust investment account. All trust monies must flow through the trust bank account to the trust investment account, and on withdrawal of the money invested from the investment account back into the trust bank account. Right, so that's looking at the detail relating to the flow of money. Okay, so moving money from the one account into the other. Right, so trust money cannot go directly into the investment. So in other words, if the client invests in their own investment account, then that's a private investment. Okay, that's not a money kept as a deposit, okay, with the law practice. Okay, so here we're looking at money that comes into the law practice that's sitting in the trust bank account that now gets transferred to a trust investment account. Okay, if your client directly takes money into an investment account, then that's their own direct investment. Okay, that's unrelated to you and them. Okay, so in other words, the money has to change hands from client to you as the law practice, then to the investment account. It can't go from client to investment. That's bad. Okay, so in other words, let's draw a picture. Client, business, let's use LP for law practice. Okay, law practice and bank. Okay, investment. Okay, the bank, the investment account. Right, so if the client invests into the bank, that cannot be allowed. That's a private investment. That wouldn't be seen as trust money. If the client gives the law practice money and the law practice gives the bank money as an investment, then we're looking at what we're looking at here. Okay, section 78.2a and section 86.3 and 4. Okay, those accounts. Okay, client money is client money. Okay, this specifically focuses on small a and section 86.3. If you earn interest on that investment, that interest must be paid over to the legal practitioner's fidelity fund or its nominee. It is therefore not the property of the legal practitioner or the trust creditors. Right, so if you take money and you invest it in a section 78.2a or section 86.3, neither the law practice nor the client gets the interest. Yes, let's write that down. Interest goes to the third party or fourth party. Interest paid to the LPFF. Okay, is that money still the client's? Yes, it'll always be the client's money, but the benefit goes to the fund. Okay, so that's the picture. Right. That's what I would like remember in terms of what the the theory has said here. Okay, question? No, you can nominate. So if you have an investment account, you can choose to either reinvest the interest or you can have the interest paid out. So if you open up an investment account, you can choose. You can capitalize the benefit from that account or you can redirect it. So this investment account with the bank, you can choose. So you as the law practice, you will stipulate who the nominee is. Okay, either the fund itself or someone else. Okay, but when I say someone else that the legal practitioners fidelity fund nominates. Okay, so that could have been a trustee perhaps. I mean, these things could be quite big, dealing with millions and billions. And all right, then obviously you want to have more oversight and you want to have more like protection that this money doesn't like disappear. Okay. So what can we do with that interest? Okay, the point I was trying to make with this is the money sitting in the bank is whose? The client's. Okay? It's the client money that went to the law practice that went into the investment account. The benefit doesn't go back to the law practice, back to the client. The benefit gets paid out to the fund. Okay. Then you need to highlight this last part as well. The law practitioner can claim back bank charges on the trust bank account and audit fees back from the fund. So what can I use the interest here? So the interest can be used to pay bank charges only and audit fees. Possibly. Okay. Subject to certain formulas and requirements. Okay, so there are terms and conditions that need to be met, obviously, because and then claim it back. Sure, yeah, obviously, because they don't want to give you money in advance, because then who knows what you're going to do with it. All right, so bank charges and audit fees, that's what you're doing here. Okay, and there's the first bit. That's the diagram. That's the knowledge. That's all. Okay. Right, the example is quite straightforward because it just explains what we just looked at. Okay, so let's approach this the same way we approach the theory by drawing a picture. Example 8.1. The following information was obtained from the accounting records of Wintrish. 1st of June, the balance of the trust bank account of Wintrish attorneys. Okay, so here's the picture. Trust bank. Whose money? Clients. The balance in the bank account was 250,000. So the balance is 250,000. Mr. W decided to invest 80,000, not immediately required. That's important because that meets the rules. I don't know if they'll give you theory questions. They might or might not. I don't know how much detail you need to know. Okay, the accounting is a straightforward answer. They'll definitely give you that. But how much of the theory they'll test, we don't really know. Okay, they tested a little bit of it in the assignment. I don't know if they'll still test some of it in the past papers. Maybe, maybe not. Okay, so something like that I would be highlighting, but based on theory. So I could discuss it in terms of the rules. In a special interest-bearing account with WinBank. Right, so now you know that the bank, W Bank, what is that? That's the investment. Okay, so the trust bank account is the trust money, so the money from the client. So let's draw the client here at the top. Client. Okay, so what would have happened? Well, the client would have given us 250,000, but they didn't give that to us in June. That took place previously. Maybe in May, maybe in April, maybe in March. It doesn't matter when. But that's happened previously. Currently, as it stands, so today, on the 1st of June, there's 250,000 sitting in the trust bank accounts. Right, we're going to be depositing 80,000 into an investment account on behalf of the client. They should have specified what investment account this was. They should have said section. Well, okay, yeah, in the heading. In the heading, sure. But it should have been in the question. Okay. Yeah, so this is an example relating to what we just did, which is fine, but yeah, that should have been maybe over here. Okay. Right, so that's the first part. 30th of June. Right, 1 month later. This particular savings account has generated interests of 800 Rand. 800 Rand is the interest that's on top of the 80,000 that was invested. The total from the savings account with WinBank is now deposited into the trust bank accounts. Is that allowed? No. Okay, based on section 78.2a, this total of 80,800 needs to be split. How much goes back to the trust accounts? 80,000, good. See, we've just read the theory, now it's simple. 80,000 goes back to the trust accounts, and a fourth party, the Law Practitioners Fidelity Fund, gets the 800. Right, and that's what you're going to be doing. Okay, so that's the diagram, that's the picture, that's what happened. Now we just need to account for what happened. Right, so now it's simple because now we've got the understanding. Now we just need to see, well, what did they want? Okay, number one said they want the trust cash receipts journal. Okay, so I'm just going to do workings for this example. Example 8.1. Okay, the trust cash receipts journal. Okay, what does the trust cash receipts journal record? Any receipts that come into that account that belongs to the client. Okay, so is there any money that came into this account that belonged to the client? No. The 250,000 was from before. Yeah, that's later. Is there a balance? There is a balance, the 250,000. The 250,000 is what they started with. That's the balance. Right? They didn't say the client gave 250,000 on the 1st of June. Do you see that? I'm saying, what money did the business, the law practice, receive? 250 previously, and 80,000 when the investment paid out. 80,000, but well, 80,000 will come back to the trust bank accounts. 18,800 is the total that the received, but part of it goes to the. Okay, so they've wanted you to show all of it. Okay, I would have shown this differently because I would have shown the 800 going straight to the so they're showing more steps, which is fine. Yeah, which is fine. So if they follow what they've done, then rather, because this is the trust cash receipt. So basically what they've said is we need to change the diagram slightly then, if we're following what they've done. Okay, what we actually need to do then is this. We need to put all the money see, but to me that doesn't make sense because when we read the theory, they said the 800 gets paid out to the, so it goes direct. Okay, it doesn't go to the law practice and then it goes into the fidelity fund. change the diagram slightly, we need to show it this way. Okay, so then I need to show 80,800, all right? That gets sent to the trust bank, and then 800 is then sent to the Fidelity Fund. Okay, if that's what they want you to show you, then show it that way. Just stick to what they've got. Okay. Yeah. All right, so this gets given back to the trust bank account, which is what we've got here. So debit the bank, credit the trust creditors. That's simple. That never changes. If money comes into the cash receipts journal, you always do this. Always. That will never change. Do you agree? Okay, never ever change that, because bank will always go up in a cash receipts journal. The trust creditors will always go up because you owe the client more money. Okay, so that's the first part that they've shown. That happens on the last day of the month. Okay, then the payments. How much do we pay? Well, 80,000 is what would have been paid to the actual investment account. The date here should have been the 1st. Didn't we invest on the 1st? Yeah, we did. Okay, should have been the 1st, not the 31st. Just correct that. Yeah, correct that. Right, you invest on the 1st of June, not the 31st of June. Typo. Okay, so that's the payment. Payment is obviously money coming out of the client's account. Right, which is what we had here on the diagram. Let's go back to our diagram there. Okay, so if I put a date here, this would have been 1st of June. And that would have been 30th of June. Okay, just to show the dates there. Right. Okay, so there's the 1st of June. 80,000 was paid out. 30th of June, money coming back in. Maybe just to move this down, the receipt came after the payments. Alright, so TCPJ, there you would have debited the trust creditors and you would have credited the bank. I should actually put trust bank here to be more accurate in terms of my working. Trust bank. Right, and that you would always do. So this payment always applies when you have a payment coming out of the trust money. Okay. Right, which is what they're showing there. Right, so 80,000 came out. That would have happened on the 1st of June. And where would it have gone? It would have gone to the investments. Okay, so you would have debited. Right, see, the reason why I want to show you these workings is because if they ask you for T accounts, and you can draw up the T accounts, what do? I debit the trust creditors with 80. I credit the trust bank with 80. Right, so the only reason why I'm showing this is just to the T accounts. Okay. Yeah, so then this would help you to do that, if that's the next part. Okay. And then 80,800 comes back. And then obviously 800 needs to be sent to the Fidelity Fund. Okay, trust journal. This is a new journal. Yes. We'll discuss it just now. General journal for the trust transfers or trust transactions. Trust transactions that are unrelated. Let's use that. Okay, so the only reason why I'm not using a CPJ or a CRJ is because this is a different transaction. Okay, you know general journals record other transactions. Okay, transactions that are different. Transactions that are unusual. Okay, not receipts and not payments. Okay, that's why you've got this. Okay, so if you look at this, you've debited and you've credited the Trust Fidelity Fund. Okay, so earlier, when we read the theory, Okay, when we spoke about VAT, okay, do you guys remember the VAT example? When you sell something, so when you render a service to your clients, you are going to bill them with VAT because it's a service that is VATable, right? Are you going to keep the VAT? No, not input, VAT output. Okay, when selling, remember, goes out, output VAT arises. Okay, are you obligated to pay this over to the facility fund? Yes, exactly. Obligation. See, the rules tell you what this is. So to answer your question, how do we know what to debit and credit? Apply the rule. Okay, is this money mine? No. This money is the fidelity funds. There's an obligation to pay. This would be seen as, inverted commas, a liability. Interest that is payable to the fidelity fund would be seen as a liability because it meets the definition. It's an obligation to pay over the interest to the fidelity fund. Make sense? Okay. So maybe add that to your working here. You can put brackets here, liability, inverted commas. Okay. Why do you debit? Because the debit is for the actual investment account. This is the totals. Those are totals. That's a total. Yeah. Because this is the control account, that's everybody's, and this is the legal practitioners fund. So no, it's the same as what we had here earlier. So remember when we had Modise, Governor, and Corsi? They're all trust creditors, right? Do you see that? Okay, so here you would have had a separate account which would be the control account. Trust creditors. Okay, so trust creditors, this would have been everyone, right? Okay, so if it's everybody's account, I could put all those transactions in this one account. So if I had to debit and credit, right? If I'm receiving money from a client, I'm going to debit the trust bank account. And I'm going to credit the trust creditors. Right, in actual fact, it would have been trust creditors and also credit the trust creditors, let's say, Nkosi, okay, comma, Modise, comma, Stain, comma, Governor. Do you agree? Okay, because you're recording it twice. You're recording it in the control account, which is everybody's, and then you're also recording it in their separate account, which is belonging to the client. So in this example, here they said, debit the investment account, okay, win bank trust creditor. Okay, we had that earlier. Where was that? Here. Win bank trust creditor. Right, receiving and paying money. When you paid money over to the trust creditor, you created the account, and then you debit the account. Because there's the debit, and there's the credit. Yes, because that's what I'm trying to say. It's the total. It's the total. So, see, okay, so this was what? This was a cash receipts journal, trust cash receipts journal, and then what happens if I have a trust cash payments journal? Well, then I would have debited what? The trust creditors and all the individual clients, and then I would have credited the bank. Okay, so what would I have done to this account? I would have debited and credited the trust creditors accounts. Okay, because it's the total, it's everybody's accounts. Okay, so these are just totals. That was what I was trying to say when I put that. It's just a total. It's the total. That's why it's the control account. Control account means total. Everybody's account. Trust creditor is individual person's accounts. Win bank, legal practitioner's accounts. Okay. Is that alright? Okay. If there's questions, ask, because it's important to fully understand it. Okay, it does help. And that was it. Yes, which is what we did here in terms of the debits and credits, in terms of workings. Right, so you would literally debit the trust creditors, credit the trust bank, debit the trust bank, credit the trust creditors. And you would also have to do it for the individual clients if they ask you for the individual clients. They probably don't ask you for individual clients, yeah, they didn't. See, everything goes in one account. Okay, so when I had let me show you this, debit trust creditors, there's the debit trust creditors. Credit trust creditors, credit trust creditors. There's the debits, there's the credits. Okay, that's the power of the working. The working is the answer. You just need to get it. Right, the better you are doing this, the easier it is to do any of that. Okay, just stick to the basics. Yeah, just the 800 that they've got here, just to highlight and discuss it, that's the interest. Remember, who gets the interest? The Fidelity Fund, because this was that special 2 small a account. And then they would have shown that here. There's it. Okay? If you want to, you can write liability next to this, because now you can see why it's on the credit side, not the debit side. Okay, because basic principles still apply. You are obligated to pay the legal practitioner Fidelity Fund. So this would be seen as an obligation. This would be seen as a liability. You would not show a debit on this account. You would show a credit because it's an amount that's owed to that particular account, business, individual. Okay. Makes sense? Great. Right, so that's the first type. That's type 1. The last type that we need to look at is this one. Here's the last bit in this chapter. Capital A, 86.4. There's the next bit. So earlier we saw there were 2 different investment accounts. Type 1 was what we just spoke about. This is type 2. You can read this again. They just talk about separate accounts, client money, business money, separate investment accounts. Okay, the important bit is this bit at the bottom. This you should highlight and underline and circle. Let's highlight the key bits and pieces that we need. 100% of the interest earned on a section 78.2 capital A of the Attorneys Act must be paid over to the trust creditor. It is therefore not the property of the attorney or the Fidelity Fund or its nominee. Interest earned on a section 86.4 type account is treated differently. Okay, so I'm going to summarize this just now, and then you'll see the main summary for it. If it's a section 86.4 account, 95% belongs to the trust creditor and 5% belongs to the Fidelity Fund. And that's the last part. Okay, so let's summarize all of that here. Summary for chapter 8. Investments and interest. Okay, clients. Law practice. Bank. Well, let's say investment. Okay, so NB. section 78 small a NB. Money invested must be paid to the Fidelity Fund. Right, how do we transact? Well, the investment money is paid back to the law practice, and the law practice splits it. Okay, that we had to confirm, which you confirmed for me earlier, so that's good. So well done. Let's just show that. Okay, so this goes to the trust bank account, and this goes to the Fidelity Fund. Fidelity Fund, bracket, inverted commas, liability. Right, that's what we just spoke about. That's the summary for that part over there. Okay, now we just read something related to who? The investment account, but now we look at the client. So the client gives you money and you invest it in a section 2 capital A account. If it's capital A, how is capital A different from small a? Well, the client gets everything. That's good. Okay, so I'm going to copy paste the whole thing. Right, delete this, delete that. Okay, so the Fidelity Fund doesn't get anything here. So let's write that down. Section 2 capital A, all the interest is paid to the client. That's section 2 capital A, big A. Right, so that's what would have happened. Right, so we forget about the Fidelity Fund, we forget about the law practice. Okay, all of it goes to the client, 100% back to the client. Right, and then the last one, which is the most complicated, copy paste. Section 86.4, sorry, wrong one. 86.3 was the other one. This is 86.4. 86 bracket 4. Okay, so only for this one do you need to split it twice. Okay? What happens here in this particular scenario? Well, client gives law practice money, law practice invests that money in a section 86.4 account. Okay? The interest is split. 95% to the client, 5% to the Fidelity Fund. So let's show that. % interest is payable to the Fidelity Fund, which is abbreviating, inverted commas, liability. Okay. The trust gets the 95%. Right, and that's what we've got there. And that's the last one. Okay, that's the last scenario. That's scenario, well, 2, but 2 had 2 parts. Okay. Right, so 100% of the interest earned on Section 78.2a stays with the trust creditor. Section 86.4, 95% goes to the client, trust creditor, 5% goes to Fidelity Fund. Simple, save. Okay, that you guys can maybe just print out later when you get this. I'll email it to you. You can use that as notes. Okay. Right, let's look at one example. I think the correspondence, how are we doing with time? Oh no, we're doing okay. Right, we can take a quick little 5-minute breather and then we can look at the last section. Okay, we'll finish before 1:30. Right, example 8.2, the accounting treatment of section 78 capital A and section 86.4. Right, so now remember we just need to picture our diagram. This, everything 100% clients. This, 95% clients, 5% Fidelity Fund. Right, this is what this example is giving you. Okay, explaining, showing. It's very similar to the other one that we saw. The only thing different is how you treat the interest, how you split the interest. Everything else is still the same. Okay, so if I read it, 30th April, client E deposited 218 to the trust bank account. Okay, let's do workings again here. Example 8.2. April 30, deposited money with the business. The client deposited 218 to the trust bank account of Micah Attorneys. 280 was deposited payable by E on a property purchase from the City Council. Yeah. Well, did they ask for... Okay, they only asked for May. Okay, if they asked for April, then you would. Okay, so they just wanted you to record the records for May. Yeah, I'm just discussing everything just so you have the background as well. Okay, so 30th of April, you would have debited the trust bank. You would have credited the trust creditor. That you've looked at last week, this week, it's always the case. That doesn't change. Okay, we could even copy paste what we wrote previously on the previous example. Right, after having received money from the client, on the 1st of May, E instructed M to invest the full amount, 280, in an interest-bearing investment account at African Bank in terms of section 86.4. That's very important. See, you need to look out for that in the exam, because now you know this is 95.5. That's important. That you'll need to know. Okay, that you'll have to remember, study. Until the transfer of the property is effected. Okay, that can take a few months, depending on when the deal is concluded and all of that. So, if I'm looking at that, I now know that the client is going to reap the most of the benefits, and 5% goes to the Fidelity Fund. What am I going to do? Well, trust CPJ, this would have been trust CRJ, just to add that there. You would have debited the trust creditors, and you would have credited the trust bank. Again, same as before, you always do the same thing when you move money out of the account or when you move money into the accounts. I'm just moving money out of the account into another account, into an investment account. Okay, how much money did we move? We moved all of it, 280,000. The balance of the trust account after the deposit into the trust account, but before the transfer to the trust investment account was. Okay, so that's the balance sitting in the account prior to having done the transfer. So they transferred 280,000 prior to this. They would have given you a balance of, well, what is the balance? The total here is 720,000, okay, less the 280, is 440. Okay, so before they gave you the additional 280, they would have given you the 440. They would have come from long ago. Okay, they're telling you that the 720 is before the transfer to the account. Okay, balance in the deposit account before the transfer to the account. So that would have been the balance at 1st of May prior to that deposit of 280,000 that took place on the 30th of April. Okay. On the 30th, the property was registered in the name of E. Day 31, you withdrew money from the investment account. Okay, so let's draw the picture. The picture is going to be this one. Copy, let's paste it. Okay, I want to show the movement here. Okay, movement went into the investment accounts. TCPJ 280,000. Okay, balance in the law practice for the trust bank accounts. Maybe let's write this down here because it's the law practice, but it belongs to the clients. So let's just move the heading. Okay, balance here was 720. Okay, you minus 280 because you moved money there. Okay, you can't really see the red on this projector, but I'm just highlighting the minus. That negative 280,000 is red, and so is that. Okay, that's the negative. See that? Okay. Then what happened? The investment paid out how much? Add back 282,400. Okay, this is going to be green. I'm just going to use another color. Or let's highlight it in green. There we go. And let's show that money coming in. Right, so that big arrow is for the 282,400. Right, that amount of money is coming from the investment. So you invested 280, you're getting back 282,400. This is coming back into the law practice, back into the trust bank accounts. Okay, and then we just need to show the splits. So according to the legislation, when we invest in this particular account, we need to split it. $282,400 is split. It's split into two: the interest portion and the original trust money. The trust money was originally 280,000. The interest portion was 2,400. The interest is split. 95% of this is the client's, 5% of this is the Fidelity funds. Does that make sense? Okay. Yeah. Pictures tell 1,000 words, so I like drawing diagrams. I can do it now so you can see it, and then we can just show it. Okay, so that amount times 95% is that figure, and the 5% is the difference. There we go, 120. Okay, and see, once you've got that understanding, then you can draw up all the journals and ledgers if you need to. Okay, it's the same as what we did before in terms of workings. Right, so let's go look at the Trust Cash Receipts Journal. Okay, we drew our diagram. Trust Cash Receipts Journal, the Trust Cash Receipts is going to get the 282,400. There we go. Trust Cash Receipts Journal. Remember, this is for May. We're not looking at April. We're just looking at May. So this is the payout from the investment account. Bingo. That's on the mark. Okay. The Trust Cash Payments Journal. What does that show? That shows the payment, which was this. There's the payment. The TCPJ. That was the payment we made when investing the money. There's the investments. That's fine. And then this is just look at the interest. This is the splits. Okay? So here I showed the splits. 2,280 and 120. 5% goes to the Fidelity Fund, 95% goes to the client. That goes from the investment account. Okay, makes sense. All right, and that's chapter 8. That's the interest part.